I'm here with Deputy Fund Manager James Timpson to get a roundup of market performance throughout April. James, thanks for the summary on the markets. How have things been?
Well, market volatility has continued to remain fairly elevated. This is due to the ongoing uncertainty surrounding what's going on in Ukraine, and of course inflation continuing to soar. But one market which did particularly badly last month was the US. The S&P 500 index was down nearly 9% for the month. And big companies like Google, Tesla and Amazon, they all lost close to or around 20% for the month. However, Twitter, which has just been bought out by Elon Musk, that had a rather good month. That rose 27%. So whilst most equity markets were down last month, UK large cap continued to be quite resilient. In fact, the FTSE 100 index rose just under 1% for the month. That's partly due to its exposure to big oil companies. They've continued to do quite well with the oil price so high. But also this month, it's also due to the weakness of the pound. So the pound fell against the dollar by just over 4% during the month, which is its worst month against the dollar since October 2016, so nearly 6 years. And because the FTSE 100 has so many large multinational companies, which generate a lot of their income from overseas, when foreign currencies do well against the pound, it tends to be quite beneficial for the FTSE 100. So once again, the UK market has proven to be quite resilient during these fairly volatile times.
And I mean, the investment team always makes clear we're not investing in these big tech stocks, but how's all this activity been impacting on courtiers funds?
Yeah, so relative to the market, we're quite underweight the US. The US makes up around 65 to 70% of the global developed market, or the MSCI World Index. So being underweight the US has certainly helped us a lot so far this year. And we're relatively overweight the UK as well, because we've long believed that the UK is a great value market at the moment. We do have some foreign currency exposure, which obviously helps out when the pound is struggling. And also, it's been a really tough time for fixed income or bonds at the moment. So being short duration has also been extremely beneficial, particularly for the cautious and balanced funds, because obviously they have less equity exposure and theoretically more fixed income exposure. But because we've been low duration with our bond exposure, those funds have not been badly affected by the downturn in bond prices.
Thanks, James. On the horizon, anything in particular to be looking out for?
Well, we're just expecting volatility to remain fairly elevated for the time being. So we're just doing our usual thing of ensuring that we maintain plenty of diversification within the funds. We're not going to be going extremely long duration anytime soon. And yeah, it's really more of the same, Leo. Just keep doing what we're doing.
Sure. Thank you, James. Thank you very much for your time once again. I'll catch up with you next month. To our audience, thank you very much for watching. As always, any questions, please let us know. I'll be trying to catch Gary Reynolds, our Chief Investment Officer, to have a talk about inflation. So keep an eye out for that. Thank you very much.